Hello, ladies and gentlemen. Now it's time to continue the analysis of the case study based on one critical thing, and this is foreign exchange risk. So, first of all, right now, the case study doesn't have any specific foreign exchange risk because all our revenues are realized in nice euros, and also all our expenditures are realized in US dollars. So what we have to do now is to create the workflow of foreign exchange exposure assessment. So foreign exchange exposure. So first of all, what we have to check here, we have to go through the following questions. So first of all, what is the how much USDs are we exposed or other currencies? Is this exposure significant? If yes, then we have to deal with it. If it's no, then who cares? Third point is what kind of foreign exchange change is preferred? Appreciation, depreciation. Then, what is the historical trend? Then we can see that are we supported by the historical trend or not? And also, what is expected at the futures market? After that, so when we have our position and once we realize that what we are doing here, then we can see hedge strategies. Okay. So that was the first problem, that was the second problem. Sometimes we doesn't need anything, no hedge. So we can say that, yeah, it's if not significant. Obviously, if we don't have exposure, then also we don't need any hedging. But come on, that's obvious. Then next thing is foreign exchange rate moves in the preferred direction. Still, we can say that, okay, let's safeguard ourselves against some extraordinary things, but in this case, it's quite logical or rational to say that we don't need anything. In this case, otherwise, we can do the total hedge. So, buy option to cover the whole exposure, and that's all. Or we can do selective hedge, which is much more dynamic because in this case we have to say that, okay, let's just at the beginning of the year we are checking the market and what is happening here. Can we see higher volatility? What is the nature of the business here? We are going through all of this again, and then we can decide. So in this class, we don't care about this one because that would be way more complicated. So we're just focusing on these two things. Okay, so now we have to say that what is the exposure? So right now it doesn't have any exposure here because we are using home-brewn engines. That was one problem of my setup here, because if I'm not choosing Vulkan engine, but I'm using Merlin 1D, Blue, Origin, the Russian engine, or Raptor 2, so practically anything except Prometheus, then I would have exposure. So, yeah. So let's say that if using foreign engines, not Vulkan, then obviously, since it's an expenditure, then practically we are incentivized motivated to focus on the appreciation of the euro against the US dollar. So still not enough. Now we can see it. But if this is not the case, if we're realizing revenues in USD, then practically the depreciation will be preferred. So when we have to talk about that, which case is preferred by us, then we can say that, okay, let's, yep, oh, no. Let's keep it that way. Okay, so these are the two options. Let's give a color. Maybe in this case we can see that. On revenue side, we are always looking for depreciation because it can increase, or profit in our own home currency. If it's on the expenditure side, we are always looking for appreciation of our own domestic currency. Otherwise, I don't like this because practically what you have to look for to improve your profitability, so looking on operative margins, and this is what you have to increase, not just looking for maybe I will have by miracle or luck or central bank to conduct some monetary policies. No, you are a business, not yeah. So, in my case, what can I do here? Obviously, I need revenues. And luckily, we have revenues because this is the Kuiper system, which is supposed to be Jeff Bezos' answer to Elon Musk Starlink internet satellite thingy or service, because Amazon, who developed the cloud services and lives happily from this industry, realized that, okay, but literally they should move themselves up to the clouds. So they should provide their own satellite internet, which means that they have to launch some thousands of satellites. And practically services can be operational once more than 5 or 600, nearly 600 satellites are launched, so they have to launch in a huge scale. And they have to do this rapidly because they have to reach half of the coverage already in 2016, which is 2 years later. So they have to scale up their operations. And that's why they purchased a lot of launches. And it's really funny because United Launch Alliance don't have cheap reusable rocket. Ariane Group, yes, we know them. Blue Origin, which is Jeff Bezos' own company, supposed to have, just we know that their new Glenn partially reusable vehicle will just fly maybe in September, so that will be their first flight. But still, since Amazon have infinite amount of money, then they were able to get this thing done. And also it was really funny because there was a court case where one shareholder started to sue Amazon that, come on guys, you should bid also or use shareholders' money to optimize your expenditure. So that's why they were forced by the court to book some flights also at SpaceX Falcon 9, which is obviously was not the happiest day for Mr. Bezos. So if we are looking for our nice market niche, then we can see that we will have 18 launches for Ariane 6. And we can see here. So, yeah, Ariane 6. And that's why we can say that, okay, now we should look on our profit and loss statement and see that, okay, some of this should be divided. So, how should we do this? Maybe we should create a completely new. Yeah. Let's clone all of this. So revenue generation in USD, revenue generation in Euro. Yay! Okay, so obviously this year nothing will happen. But next year, let's say that we don't want to rush because at the first year we will be terrible in reusing, so we would be much more efficient if everything would happen in the third year. So let's give Mr. Bezos one launch here because we are delivering, but since we are focusing on our own revenues, then it will be 17. And then 0 and 0. Because also we don't want to do this in the far future. Right now we have to raise money now, so we are in quite a hurry. Okay, so minus this and minus that. Also we can ask that, do we have any unit prices? I think it was undisclosed, but let's use the usual price of Ariane 6 launches. Since it's already done, it's already in our books, so why not to have some nice revenues? So let's go with the 73 million euros, because this is what we are earning here. And now we can see that it will be 73 million in US dollars. You know, we are liking the guy so much that we are charging more than the usual. Okay, and then still probabilities are the same, so let's not too bold. And then we can say that okay, let's zero these things out because it makes my life easier. And after that we can just say that okay, revenues, number of launches multiplied by unit price, unit multiplied by the probability of success. It would be so good if I could type this in, but okay. 7. And also we should multiply it with the foreign exchange rate, which is located here. Then top. Good. And still we should not use bold. Bold is somehow it's in the data. And we should also make it nicer. Okay. And then during the calculation of EBIT, we should add also this one. And now we can see that USD revenue in euro. We should not forget that. Okay, unit price in USD. Yes. So we earn more money, not just because I'm charging more, but also maybe we have some luck with the exchange rate. Okay, so now what we need here is to realize, so USD revenue in euros. Okay, so the exposure. So this number multiplied by this number multiplied by this number plus this number multiplied by this number multiplied by this number. Yep, that's in US dollars and obviously in millions. So yeah, if the whole cake is 10 billion and we have eaten 1.3 billion from it, then we can say that it's realistic. To do so, is this exposure significant? How can we decide that this is significant? So let's check based on our overall. So let's sum this up. And then let's see. Maybe not this way. Maybe we can just check. Here, exposure share from overall revenues. Because in this case we can just see that, yeah, this number divided by this number plus this number. Tip. Okay, so in the third year it will represent half of our revenue, so yes. Let's write here the comment that yes, in the third year 53% of our revenues depend on the foreign exchange rate. So we have to deal with this. Okay, what is preferred? We are preferring appreciation. Sorry, no. Realizing revenues, no, depreciation. So we need more euros for US dollars. Okay, what is the historical trend of poor euro US dollar? Then let's see. That was a time period when weak, and that was a time period when euro was strong, during obviously the 2008 real estate crisis, and then still since then we can see that it's in a depreciating phase. So we can say that it will depreciate further. So small depreciation can be expected if we are just looking on it, but also at the same time we can see that this is behaving like a sinus curve. So it's always fluctuating around the mean. It doesn't have a clear depreciating trend, like for example in the case of euro, where we can see that where this is going. So this is not the case here. Okay. Then, what is expected by market? So if you are checking, my best guess is to look for the forward markets, because in this case we can see what kind of things are they expecting, and also we can check market forecasts. But unfortunately, market forecasts end in March of the next year, so this one is utterly useless. So if we are ignoring this, then we can still go to the Euro FX futures market of the Chicago Mercantile Exchange, because they are nice people and they are providing data for free. So yeah. Then let's see exchange rates. We need some exchange rate for this year. Okay, right now we still need an initial exchange rate. So we need USD Euro because we are running our books in euros, so denomination is important. So let's say that we are just picking the last known. So we have to calibrate this line here, and I'm not allowed to copy, so 0.93. Yep. Okay, so this is for the first year. Then let's go to the market, and or we can say that, come on, we are closing our books in the end of 2024, so maybe this one is more reliable. So instead of using this one, then let's bring this. Okay. Then let's go for the next year, which is much more relevant for us. Why are you changing? Just on that. Who is referred? interest on that. Okay. Then let's go. But you should not change at all. It's recalculating things, but I don't know what is happening with Excel, but yeah. And then let's have the last data. And we can fix this. So this is where USD exchanges are coming from. This is what I recommend for you, that CME Group has. Free and excellent data, and now we can see what is happening here. Okay. You are green. Oh, let's have other green. They are different, at least. And now we can see that are they different? So we should just create a save from this one, and let's go set it back everything to ones. Okay, then what happens with the price? Share prices will be higher. Yeah, depreciation will happen, so okay, we can say that this is supported, but so if we are completely neutral, then this is the share price. Maybe I should organize it in a different way, because in this case we can see. Okay. So under realistic futures foreign exchange rate, then we are copying these things back. Now we have the data and the information, so let's see the performance of valuation here. We can see that valuation dropped a bit. So you can ask the question, does it worth the 400 euros to start to deal with all the hedges? Because still we can say that yes, significant, but it moves in towards the preferred direction. So right now we can see that, okay, this is the no hedge case. That's the value. And what happens if we are adding total hedge? In case of total hedging, then we have to think about the followings. So first of all, we need additional data. And the additional data means that we have to calculate option fees. So what we need for an option fee, we need interest rate in euros. Okay, we have many of them, but also we need interest rates in US dollars, and also we need interest rates in we need volatility in option calculator. So we have to sell or euro. Okay, and not in 1 month, but a year later. Okay, and we just have to focus on sorting, and this is the option fee here. Hedge expenditures. So we have to focus on this too. Okay, so end of 2025. Okay, delivery. European option, yes. Okay, we have to... Sorry, I would like to buy, but it will be a put option because I would like to sell. Strike price. I would like to fix the current one. Okay, so this will be my no, it's in euros. Notional. It's yeah. 64. Yeah, so you can see here the volatility, and also we can see here the interest rates, and during the prices we can still see volatility. So in this case, volatility is calculated from other options. So they are just checking the available option fees, option prices at the market, and then with the Black-Scholes scale plot backwards, where they are just estimating that, okay, what can be the volatility there. And at the end of the day, we can see that's the premium. So it will be, how much should be in euros? Okay, so the premium will be, with Black-Scholes. Okay, only Black-Scholes can be applied. Will be 2. euros for the whole thing. I mean, in this case, it will be 2 million euros. So, hedge fee 2. And also, obviously, we can do the same thing in Excel. So, okay, so if we are using our own Excel version, then it will be doing the same thing. So what is the spot rate right now? The spot rate is this. So we will have this stock price. We would like to have the same. So we would like to fix the two currencies. What is the volatility? The volatility, okay, this will come from the data. I mean market data. So what was the implied volatility? 6.628%. Okay, domestic interest rate. So interest rate in euros. Oh, and also we have volatility for a head. Okay, guys. This is much better. Okay, so deposits, interest rates. Then we should just check 1 year. Let's have the highest, so 4%. Foreign US dollars, 5.9%. And let's go back to volatility because we have different data for volatility as well. And 6.6%. Yeah, okay, that's good. Yeah, because it's already, this was checked. And okay, time to maturity in days. Are you using whole year? Yes, we are using whole year, so now business here. And then we can see that this is the put price. So now we can copy this. Oh, come on. Now we can copy this. And now we just have to multiply this number, multiplied by this number, multiplied by this number. Okay. So as you can see it, the premium was 2. Yes, it's still 2, so we verify that, okay, it's cool. Then, next year. So 1 year ahead, we can do the same thing. Start price remains, but now we are multiplying it with... Oh no! Okay, this is what I messed up. It's not 2 years. Let's keep you here. Because it was already 2 years ahead, so without changing anything, that the put price must be modified. It will be more expensive because we are going 2 years ahead. Okay, now it's 3. Yeah. Okay, so that's why it's staying there. Okay, and now we are moving forward toward the 3-year option. So this is 3 years. Then we have to update volatility. 3 years. 7.26. %. Okay, then deposits. 3 years ahead, 3.52. 3.52. And also foreign 5535. As you can see, expectations obviously about inflation, future inflation, and the smoothing out of the inflation curve is present here. So obviously it will have an impact on the option fee as well. But since we are moving towards future, and the future is always riskier, then also the longer option will increase the option fee. So unfortunately, we have to pay more for the safety. So we can say that some amount of money must be spent. And you can say that, okay, but come on, I purchased all these options today, so practically these things are not happening in this years, these things are happening right now, so I have to move them in my balance sheet, because right now we are already defending ourselves against the exposures, and this is not happening. So yeah, already we purchased the options, already we have huge losses. Hey. Okay, so I already was running out of cash. That's a problem, because we are short of money. So even if I was conservative in taking up loans, then we are not able to afford this at all. So in this case, we are forced to use partial hedging and not the whole hedging. But okay, let's check valuation, because it's for fun. Absolutely not affordable for us, but this will be the value of the company, and we can see that, yeah, it's not just not affordable, but also reduces the value so much. So we can say that, oh my god, if we are letting foreign exchange exposure into our balance sheet, then value will decrease, but once you start to hedge, value will decrease even more, because we are losing a lot of money because of hedging. So that's why sometimes companies are just trying to take the risk and not hedge this thing out. So I have to cut this back. Let's keep it here. So that was original. Second and third year. But I don't have such amount of money, so I have to scale it back. Minus 2.7. Now it's 0. So I'm doing this. Yes. I still have some kind of hedging, just not much. Okay, so 35. Okay, so exposure, we can say partial if we don't afford, we can't afford. I don't want to take up more loan for this inconvenient thing, so what will happen with valuation? So it will be a bit higher, but now we don't have cash reserves. So in this case, I would like to focus on this one. So let's go with no hedge. here because these things are utterly useless. So let's keep our books simple and let's just go to no hedge. Yeah. Okay, so I spent such a long time dealing with foreign exchange risk, and at the end of the day I told you that you don't have to deal with this at all because the company would be in a way more deeper trouble by losing all their cash reserves just to maybe not lose that much money in terms of foreign exchange exposure. So sometimes this is the answer. We can't do anything, we have to run and bear the risk. Okay, see you in the next video. Bye bye.